Hello, everyone. Today, we are going to talk about a very important standard, revenue recognition. Ind AS 115 is one of the newly minted standard, so to say, which is now being made applicable and it is relevant for the syllabus as well. Before the issuance of Ind AS 115, companies were required to follow Ind AS 18, Ind AS 11, Ind AS 18 for revenue recognition, Ind AS 11 for construction contract, and then we had an IFRIC, one kind of an appendix which used to talk about service concession arrangement, right? So there were multiple, in a way, accounting standards which were prevailing prior to the issuance of Ind AS 115. The purpose of Ind AS 115, in fact, the whole history, if I were to give you a perspective, the whole history of Ind AS 115 was actually originated as part of the overall arrangement between the International Accounting Standard Board and Financial Accounting Standard Board of United States. So International Accounting Standard Board, IASB, which runs IFRS standard, and then FASB, which runs standards under US GAAP. Both these standard setting bodies, they came together and they worked in a way, a joint project to come together or to issue one standard which is applicable in a way across the world. So when Ind AS 115 or an equivalent IFRS 15 was issued, similarly, the American standard setting bodies, they also issued a standard which is called as ASC 606, Accounting Standard Codification 606. So after the issuance of Ind AS 115, or so to say IFRS 15, there is a great degree of uniformity in terms of revenue recognition across the world. Whosoever is either following IFRS as a standard for revenue recognition or US GAAP as a standard for revenue recognition, virtually there are no or very, very insignificant differences, other than, of course, the application matter, which will continue to prevail, in different geographies, so to say. So in India, also, after the issuance of IFRS 15, the Institute of Chartered Accountants of India and the MCA, all of them formed different, in a way, groups, and then the standard Ind AS 115 was eventually issued. Ind AS 115 is a very comprehensive standard in relation to revenue recognition. So what this standard is actually trying to say, that when you look at any matter for revenue, and revenue, as you can imagine, is the most important line item from a profit and loss account perspective from any corporate entity, right? Or if you are running your own business, revenue is, let's say, the most important thing. That's the first line item which we see in your profit and loss account. So what this standard is in a way trying to say, that how do you actually get to revenue recognition? And then it defines every element of revenue recognition, the entire approach, the whole methodology, everything in a way has been covered. And then it covers not only for vanilla, in a way, sale of goods or for rendering of services, it also covers for construction contracts. It also covers as an appendix on the service concession arrangement. So all types of arrangements which is what you're going to see from an organization perspective. Ind AS 115 is a very, very important standard, right? If you are a bank or a financial institution, then ordinarily you will end up following Ind AS 109, which is on financial instrument. That is, in a way, which gives you a guidance on, recognition of interest income, so to say. But when you just try and understand for sale of goods, for rendering of services, for service concession arrangements, for construction services, for your royalty income, for your other types of, in a way, arrangement across sectors, across sectors, right? All of that is required to be now driven or covered by Ind AS 115, right? It's a fairly comprehensive standard, and what we will aim to do is to help you understand all different elements of standard, and what's the importance of this, from a financial reporting perspective, and how do you need to get through Ind AS 115 from that perspective. So we talked about what's the need of the standard. It specifies the criteria for revenue recognition. It also help you to identify what are your performance obligations. The first question, whenever you want to think about revenue recognition, is you got to think about, there's a customer, right? First of all, you need to have a customer for you to record revenue. You can't record revenue by doing transaction with yourself, right? So you got to have a customer. Now, once I have a customer, then the second thing it talks about is that you need to have a contract, right? So there has to be a contract between yourself and the customer, right? So the company which is trying to record revenue, they need to have a customer. If I have a customer, it is presumes that there is a customer contract. The form of the customer contract could be any. It could be oral contract. It could be a written contract. It could be over an email. So long it is enforceable under a court of law, it has to fulfill the definition of a contract, and we will try and understand a lot more about it. Now, once you have a contract, then what the standards suggest you to look at, that when you go through your contract, you will identify all your performance obligation under the contract, right? So what all the promises you have made under the contract, from that perspective, is what you need to identify when you go through the contract. And then, when are these performance obligations in a way are going to be satisfied? How are they going to be satisfied? Now, once you understood that there is a contract, right? So I have a contract, and then I have a customer, a contract, and then I've identified the performance obligation. Then you need to also determine the contract consideration. Contract consideration is nothing but the transaction price, how much I'm going to get compensated. So how do you actually determine the transaction price? There could be a lot of complexities, a lot of if and but. It's ordinarily simple if it is a simple transaction, right? You go and buy something over the counter, and let's say the seller will say that I'm going to charge you 10 rupees, you pay 10 rupees, and you receive the goods. It's a very simple transaction, right? There was a customer, there was an oral contract, there was a demand, and then the demand was in a way fulfilled, and the consideration was exchanged. It's a very simple arrangement. But in practice, you will see a variety of arrangement, and that is what we will try and talk about. That is what we'll try and understand. So once you have understood that I have a customer, I have then need a contract, and then I will go through the contract. I will identify all my performance obligation under the contract, and then I need to also determine what is my contract consideration. So how much you're getting paid, right? And then once you determine your contract consideration, you determine your performance obligation, then the whole idea is that you need to allocate the contract consideration to each of the performance obligations. And why this is important, right? Many times you will see they are bundled arrangement. You're selling goods, you're providing services, rendering services, and you're doing AMC, you're doing something else. You're selling multiple goods, right, to a customer, which are being delivered at a different point in time to a customer, so to say. You kind of doing different types of services which are going to be delivered or should have been recognized at a different point in time. End of the day, accounting is a period concept, right? It's a timing of revenue recognition is very important, and when you record revenue is when you in a way fulfill your obligations under the arrangement. So I have a contract, then I have a customer, then a contract, then I've identified my performance obligation, then I've determined my contract consideration. Then I need to allocate the contract consideration to each of the performance obligation. Now, if there are variable consideration, right? If there are variable consideration, I need to determine that. And once you have done in a way all of that, that is what helps you to figure out revenue recognition, is to as and when your obligations are fulfilled, and we're going to talk more about it. And then you also need to deal with something what is called as contract cost. Now, what is the meaning of contract cost? Meaning of contract cost is, let's say, you taking up a new customer, new client, and as part of that process, you have you incur certain costs to sign up. Let's say you have to engage into lawyers fees, you have to you have to pay some commission to enter into that contract to a person who has helped you acquire that contract. It could be some internal cost, it could be an external cost, but it has to be incremental cost which you have otherwise wouldn't have incurred if you would have signed this contract. So it has to be incremental cost of you entering into a contract. That is what is called a contract cost. And we will again try and talk a lot more in detail from this perspective. The whole purpose and objective of revenue recognition standard is to give you a very comprehensive framework which will cover all the elements as what we've talked about, and then how do you eventually apply all of this in practice. From that perspective is what you need to understand. It is the most important standard which one needs to understand. It is what one needs to be conceptually very clear for you to be confident about the whole accounting, right? Because most of the accounting in a way is driven to first you understand the customer contract, you understand your performance obligation, you understand what is the meaning of contract consideration, how do you allocate the contract consideration to each of the performance obligation, and then when do you actually recognize revenue. All of that is what is kind of spelled out in this very, very clearly. So when we look at the importance of this standard from an examination perspective, needless to say, this is very important. This has been consistently been covered, in all of the attempts is what we see. And then when you see here, in recent terms, again, 10 to 12 marks, subject to an aberration in May 2019, 10 to 12 marks is what this standard is worth, from an examination perspective as well. So you got to have deep understanding of this standard. You got to figure out, what is it is trying to say, have a better conceptual clarity, and then of course you should have the ability to apply this in relation to a situation, and we will try and talk more about all of this. We will go through a lot of practical examples, and you will have a lot of practice questions which you can in a way look at. So all of this in a way will help you to acquire a deep understanding about revenue recognition, which is Ind AS 115. So moving forward to talk about the objective of the standard. The objective of the standard is to help you to establish the principles that an entity shall apply to report useful information, meaningful information to users of financial statements, right? Now, users of financial statement means the owners, means the government, means the shareholders, investors, potential investors, creditors, customers, all of them can be your users of financial statements. So our objective is to help put together a framework, principles, so that one can provide useful information about the nature, amount, timing, and uncertainty of revenue and cash flows arising from a contract with the customer, from the nature, timing, and amount, right? So you got to look at, what are the type of revenue arrangements I have, what's the certainty of revenue in a way being recognized, is there any risk on the amount of revenue which I have recognized. So there are tons of recognition principle, measurement principle, and of course the disclosure related aspects. All of this is what is very comprehensively provided for in Ind AS 115. It helps you to specify the accounting for an individual contract with the customer. So you have a customer, that means you need to have a customer contract. So once you have a customer contract, that means understanding of the terms and conditions, right? Terms of the arrangement with the customer, that can only be in a contract, right? Unless the it is like it's just been executed on a real-time basis. If it's just been executed on a real-time basis, then it's a different issue. Otherwise, you have an individual contract with a customer. The principle is that an entity shall recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. What does this mean, right? In a way, what it says that you should record revenue, right? You should record revenue as and when you fulfill your performance obligation under the contract, and in exchange of your fulfillment of performance obligation, which is what, which is sale of goods or rendering of services. So whatever you were supposed to do, you have done it. In exchange, whatever is the contract consideration you are entitled to, is what in a way you got to record as revenue, and provided that's your central business activity, that's the purpose of this organization, that's the purpose in a way of your existence, that this is what you want to set up as a commercial organization, and that is what you want to sell, that is what you want to render services, or you want to do construction, or you want to provide a telecom services, or you are a manufacturing company, so on and so forth. So the purpose has to be the central theme, from a revenue recognition perspective. So the principle is that the entity shall recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflect the consideration to which the entity expects to be entitled in exchange for those goods or services in that sense. Now, talking about the scope of the standard, right? The scope is fairly wide. But if you just kind of recall the principles we talked about, right? When you think about revenue, whatever is the inflow, cash flows from that perspective, is it in a way suggests that there is some element of income, right? Which is out there, but you got to figure out whether it's an income, whether it's a reimbursement of an expense, or so on and so forth, that it qualifies as an income, and then under what standard from that perspective. So similar to the principles which we have laid out, if a very specific accounting standard talks about a particular type of income stream, then you're going to go into account for in that standard. For example, government grant. Now, government grant has to be accounted for under Ind AS 20, from that perspective, not under Ind AS 115, even though you may have inflow of resources as a result of a government grant from that perspective. Similarly, if you have leasing as an income, then you account for that under Ind AS 116, not under Ind AS 115. Similarly, if you have insurance as an arrangement, then you would account for this under Ind AS 104, not Ind AS 115. Similarly, if you are doing oil and gas or exploration, you would account for it under Ind AS 106, not under Ind AS 115, so on and so forth. So you got to look at all the arrangements, what you do, what type of business you are in. If there is a specific arrangement, right, sale of non-financial asset, they're not an output, like if you're selling your property, plant and equipment, they are not in a way akin to revenue, but they're covered as part of the standard, but not recorded as a revenue. So what's not in the scope? Leasing contract, insurance contract, financial instrument, which is covered. So leasing contract covered under Ind AS 116, right? Insurance contract covered under Ind AS 104. Financial instrument covered under Ind AS 109. Non-monetary exchange between entities in the same line of business, that means transactions which do not have commercial substance. If the transactions do not have commercial substance, they are also not covered. Here it is important for us to assert that the transactions with no commercial substance, with no in a way commercial substance, so to say. If you're doing a transaction with no commercial substance, again, that is not included as part of the Ind AS 115. What is included is contract with the customer, sale of some non-financial asset, they're not an output, and that normally includes the property, plant and equipment, but they're not recorded as revenue, but they're guided by the principles under Ind AS 115, and also it covers the contract cost, capitalization of certain costs related to contract with the customer, from that perspective. all of that is included as part of the standard. So remember the principle: if there is a specific standard, you will go and account for it in that specific standard. If there is no specific standard, then you come to Ind AS 115 in relation to all your revenue arrangements. Let's look at some of these key definitions. So when you think about a contract is an agreement between two parties which has to be enforceable under a court of law. A contract can be in any form. It can be written, verbal, over an email, or in any other form like fax or anything like that. So till the time that is enforceable. So the contract has to be enforceable in a court of law. So you got to go guided by the jurisdiction in which you are operating in a way which either of the parties can legally compel the performance of the other is called an enforceable contract. From that perspective, what is a contract asset? Now you've entered into a contract, you've done a performance of your obligation under the contract. As a result of that, you are entitled for a consideration from the counterparty. That is nothing but a contract asset. So I have done a transfer of promised goods or services. As a result of a transfer of promised goods or services, I'm entitled now for the contract consideration. That is your contract asset. In exchange of goods or services that the entity has transferred to a customer, when that right is conditioned on something other than a passage of time. If you only were to get it something other than a passage of time, that means you're only getting interest, right? Then you account for it under Ind AS 109, not under Ind AS 115. Similarly, a contract liability, again from a customer perspective, if your entity obligation to transfer goods or services to a customer for which the entity has received the consideration from the customer, that is what is called contract liability. So you have already received the consideration, right? But you haven't yet transferred the promised goods or services, then you record that as a contract liability. If you have transferred the promised goods or services and you are entitled as a result of the transfer contract consideration, which is the promised contract consideration, then you're going to record that as a contract asset. Like, who is a customer? A party that has contracted with an entity to obtain goods or services that an output of the entity, ordinary activities, right, in exchange for consideration. So, these are very, very simple in a way definition. You got to simply relate to it. Who is the customer? Customer with whom I have a contract, right? Now, what type of why I need this customer? Because my purpose of this business is to sell a good or render a service. So now a customer walks in, that's the purpose, that's my ordinary activity, and the customer is the person who's going to purchase, either a good or demand a service. That is what I've been set up myself for. Now, what is a contract? Contract is something which is enforceable under a court of law. It can be in any form. Then when you look at a contract asset, that now I have fulfilled my performance obligation. In exchange, now I'm entitled for a contract consideration. That is nothing but a contract asset. What is a contract liability? You have actually received an advance, right? You received an advance from the customer and you're yet to fulfill your performance obligation, or you have yet to transfer the promised goods or services which has been part of the customer contract. Till the time that happens, you're going to, if you already received the money, from the customer, you don't record that as income, but you record that as part of contract liability, from that perspective. So all of that is some of these key definitions, from the standard perspective. Now, when you look at the whole transition, right? So as I said, before issuance of this standard, entities were following Ind AS 18 or Ind AS 11, right? These are the two standards we were following. Now, this standard has fundamentally changed, right? How do you record revenue? When do you record revenue? How do you do measurement? The timing has changed. The presentation has changed. Many things have changed under the standard. So you got to look at the transition. Now the transition, so this standard in a way became mandatory from financial year beginning April 1, 2018, right? Effective for annual reporting period beginning on or after April 1, 2018. So in a way, most of the Indian companies have now already transition to Ind AS 115. So it was, the transition principles were very relevant for companies who are actually preparing Ind AS financial statement for the year ended 31st March 2019. For them, these transition rules were fairly important. No longer, because the companies have transitioned, but if you were to understand the transition rules, so there are two ways the standard in a way allowed you to transition from your existing gap to new gap, and the two methods were full retrospective approach and modified retrospective approach. Right now, what's a full retrospective approach? As you know, let's say if you are doing a Ind AS, right, and we are, let's say, in 2020, you also need to do 2019, right? You have to do comparative period financial statement. And if you do a comparative period financial statement, in a way, I also need to do my opening balance sheet as on, let's say, in this example, as on April 1, 2018. So I need to do my opening balance sheet as of April 1, 2018. Then I need to do my 1819 and then 1920. Now, assuming I'm doing a transition, right? Assuming I'm doing a transition in the year 2020, because from my perspective, let's say that's the date of application, then what the full retrospective approach suggests is that you're going to apply Ind AS 115, and now 2020 you're going to apply Ind AS 115 for 2019, and for all open contracts which are prevailing as of April 1, 2018, you'll make this adjustment as part of the opening retained earnings. Okay. If, let's say, if you were to not to follow full retrospective approach, but you follow modified retrospective approach, and let's say you were doing financial statement for 31st of March 2020, then what essentially the modified retrospective approach suggests that you don't need to do anything for 2019. You only make the change and apply it for 2020. What does that mean? That you make an opening retained earning adjustment at the beginning of the 2020 from that perspective. So here you will make a opening retained earning adjustment. So many companies followed, there was a mixed bag when Indian companies transitioned in 2019, but large number of companies in a way followed modified retrospective approach. In a way, they only changed for 2019 and adjusted any transition impact to the opening retained earning as of April 1, 2018. But you had the choice. You could have done full retrospective. And why many companies did full retrospective? Because it helps them in a way to demonstrate the comparability of financial statement. If you do full retrospective, your financial statements are comparable, right? If you don't do full retrospective, then they are not that comparable, and then you need to do a reconciliation that if you were not to transition, then this would have been your revenue. If because you've done the transition, this much is your revenue, so on. And so the disclosure requirements were different depending upon the method of transition. But as I said, this is now in a way no longer going to be applicable for a set of companies who continue to prepare financial statements under Ind AS, because the transition date has already now in history, so to say. But it is important. Now, why the transition rules are generally important? Now, if you don't have a transition rule, right, then you end up following the principles which is laid out in Ind AS 8. And what does that mean? That if there's any change in accounting policy, Ind AS 8 suggests that if there's any change in accounting policy, then you are mandatorily required to do it on a retrospective basis, right? So say that all the periods presented in the financial statements are required to be on the same basis from that perspective. Yeah. So that was the set of in a way transition. So Ind AS 115 in a way was issued now in practice, followed by every Indian company following Ind AS as an accounting framework for the purpose of preparation of financial statement. The standard is fairly comprehensive. It is now one universal standard followed across the globe by companies who follow either IFRS, Ind AS, or US GAAP, right, as a form of accounting framework to prepare their financial statement. So it's a very, very a fantastic development from an accounting reporting comparability of financial statement. And again, this is one universal standard for which is applicable across sectors, except your financial services companies, which in a way will end up following Ind AS 109, or if you're a leasing company, you follow Ind AS 116, you're an insurance company, you follow Ind AS 104, you're an oil and gas company, you're going to follow 106, if you're an investment property, you may want to follow Ind AS 40, so on and so forth. But wherever there is no specific guidance, if you have a government grant, you will follow Ind AS 20. But if you don't have a specific standard, you will end up following Ind AS 115. So even if you're following in a specific standard, but your transaction, there's no guidance, then you will draw up in a way guidance from Ind AS 115 to do an appropriate accounting, which is to say that, there has to be a customer, then there has to be a contract, and then there has to be, determination of your performance obligation, and so on and so forth. And we're going to talk a lot more as we progress about this. So I'm going to now quickly talk about recognition under Ind AS 115, and then the 5-step approach. It's a 5-step approach. And we're going to lay it out for you that how this 5-step approach in a way is played out from that perspective. So when you look at this 5-step approach, what it suggests that step number one is you've got to identify the contract with the customer. So I suggest, as I said, you got to have a customer for you to have revenue, and then you got to have a customer contract, right? So once you've identified the customer, you need to have a customer contract. So that's the step number one. For you to get to revenue recognition, you got to have a customer, you got to have a customer contract. Now, once you have that, step number two is determine all your performance obligation under that customer contract, right? Identify the performance obligation in the contract. So once you identified, now these are my performance obligation. Now, what are your performance obligation? I need to sell these goods, I need to provide these services, I need to do an after maintenance, I need to sell these goods at different points in time, so on and so forth. So there is a performance obligation which you need to identify. And then once you identified your performance obligation, you got to determine the contract consideration. So what is the transaction price? What is it I'm going to receive as and when I fulfill the performance obligation? Now, once you have determined the transaction price, then I need to allocate. That's the step number 4. I need to allocate my transaction price to each of the performance obligations which are identified in the contract. So it's very, very important for you to identify all the obligations under the arrangement, and then you need to allocate the transaction price to each of the performance obligation. And we will try and understand and learn with example that how you need to follow each of these steps. Now, once you've done the allocation of transaction price to each of the performance obligation, then you need to record revenue as and when these performance obligations are satisfied. As and when you fulfill your performance obligation, you got to record revenue. So 5-step approach: identify the customer, determine all your performance obligation, identify or determine the transaction price, allocate the transaction price to each of the performance obligation, and then record revenue as and when these performance obligations are fulfilled. All these needs to come together, for you to do an appropriate revenue recognition. And then, of course, you got to deal with the disclosures, presentations, and also contract cost. And we're going to again cover in more detail each of these steps, that how do you go about identify the contract and the customer? How do you go about determination of performance obligation? How do you determine your transaction price? How do you figure out that? How do you allocate the transaction price to each of the performance obligation? And then what are the points of revenue recognition, whether it's a sale of goods or rendering of services or construction or service concession, so on and so forth. So we will again try and understand each of that in great degree of detail. But at a fundamental level, these are 5 steps is what you need to follow. Identify the customer contract, determine all your performance obligation, determine the transaction price, allocate the performance obligation to allocate the transaction price to each of the performance obligation, and then record revenue as the performance obligations are being fulfilled. So now with this, we move to step 1. And I'm going to take a pause here.